Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Stitch Fix's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Stitch Fix is an online service using algorithms and data science to deliver personalized clothing items based on size, budget, and style. The company is headquartered in San Francisco and was founded in 2011. It went public in 2017 and currently trades on the NASDAQ. It currently has 3.4 million users. The company began by catering only to women, but it has subsequently expanded to men's clothing, plus sizes, maternity wear, and kids. The process starts when customers fill out a survey online about their style preferences. A stylist at the company picks 5 items to send to the customer. Stylists pick items based on a customer's survey answers and any access the customer gives them to their social media accounts. The customer schedules a date to receive their items, which is referred to as a fix. Once the shipment is received, the customer has 3 days to choose to keep the items or return some or all of them. Customers choose the shipping frequency, such as every 2 weeks, once a month, or every 2 months. Let's get started with the model. This is a mid-cap company, 5.4 billion market cap. They're trading at $52.53 a share, and they have 103 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had positive free cash flow in 2018, 19, and 20, but negative in 2021. Net income is the profit and loss on the income statement. It's revenue minus expenses. That was positive in 2 years, negative in the other 2. Revenue is the sales for the company, and that looks really good, going up from 1.2 billion up to 1.8 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. And the difference between those two numbers is their gross profit. And their gross profit peaked in the trailing 12 months at 786 million. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income. And they had their worst operating income in the trailing 12 months, negative 120 million. Since they're trying to grow their business, they have high operating expenses, leading to negative operating income. Below that is the interest they pay in their debt, then other income and expenses. This is usually impairments or write-offs. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income. And that was negative in 2020 and the trailing 12 months, positive in 2018 and 19. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So they do generate positive operating cash flow each year. They did have the lowest in the trailing 12 months at 10 million. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. They did have positive free cash flow every year except in the trailing 12 months. And the company generated over $129 million of cash flow when they IPO'd. And they're not issuing much debt to run their business. They're mostly running their business on equity and free cash flow. Let's look at the capital structure. $430 million of equity, $160 million of debt. They're 73% equity, 27% debt. Their net debt is negative $147 million. And their WACC is 9.14%. And that's the discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7. That's 8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.9 billion. We divide that by 103 million shares. And we get a calculated stock price of $48. They're trading at $53, so they're trading at a 10% premium. It's a sell according to the model. Simply Wall Street is way higher than me. They're at $116 a share, so they're saying the stock is really undervalued. I feel I was pretty aggressive with their future free cash flow growth, up to $500 million in 2026. But I'm still coming up with a stock price below what they're trading at. As you know, the stock price is not based off of how well a company's doing. It's based off of supply and demand of the market. So if the market is very bullish on this stock, they can push the price up way higher. So you could make a lot of money on a company that's not making any money. You could lose a lot of money on a company that's making a lot of money. It sounds ridiculous, but that's how the stock market works. This is the stock price since the company IPO'd, and it was pretty flat for a while, and the stock was really driven up at one point. It looks like close to $100, but it's come back down to $51. They have a really high beta, 2.14, so the stock moves more than 2 times the market. It's really volatile. The stock has gone up 250% in the past 52 weeks, while the S&P 500 went up 50%. The 52-week low was 15, the high was 114, and the stock is trading below its 50-day and 200-day moving average. About 2 to 3 million shares are traded each day on this stock, and this company has a really high short percentage. Nearly 16% of the shares on float are shorted. In the past year and past 3 years, this stock has outperformed its industry and the market. Analysts are forecasting this company's earnings to grow 68%, while its industry grows 25% and the market grows 19%. The revenue forecast is for this company to grow 16%, its industry 17%, and the market 10%. In the past 5 years, their earnings decreased 41%, while its industry grew 24% and the market grew 12%. In the past year, their earnings decreased 452%, its industry grew 66%, and the market grew 3%. If you invested $10,000 into this company when it IPO'd, you would have been up to $50,000 at one point. But if you're still holding on, you'd be at $34,000. Still a really good return. That's an annual return of 44%. The biggest shareholders are Baseline Ventures at 14%, the CEO at 10%, Benchmark at 9%, Bailey Gifford at 4.9%, and Vanguard at 4.9%. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Price to sales is stock price over sales per share. They're at 3.0, so investors are paying $3 for $1 revenue. Price to book is stock price over book value per share. They're at 12.4. They have a negative return on invested capital since they have negative EBIT. They also have negative interest coverage ratio. They have negative ROE since they have negative net income. Current ratio is current assets over current liabilities. They're at 2.0, so they can cover their current liabilities 2 times with their current assets. And their current assets are $300 million of cash and $200 million of inventory. So the company does seem to be well capitalized. They did have negative $22 million of free cash flow, but they have positive $265 million of working capital. So they have $242 million of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 10 companies in the same industry as SFIX. And if SFIX has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in PE because they're negative. They do have a decent price to sales ratio, but it's worse than average. They're doing better in price to book. They have a high current ratio. They have a terrible ROE because they have negative net income. They are low in debt, and they're at 5.4 billion market cap. Average is over 8 billion, and they don't pay a dividend. So to summarize, I have them trading at a 10% discount. I'm not that big of a fan of these types of services. Although I could see a lot of people being interested in this, I still think shopping in stores is always going to trump home delivery. Because clothing is such a personal experience, I think people like to go to stores. They are doing a good job at growing their business. They just have to keep doing that and become profitable. And of course, you have to be concerned with competition as well. I rank their free cash flows 1 out of 10, their revenue 7 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.